So here we go. This is a live example here, okay? So the this is right now price action, but this is how I blend some of these concepts. Okay, so here we've had a run up yesterday. What we've also done is we've taken old liquidity from this level here, okay? Also, yeah, so sorry, this old liquidity. Okay, so we spoke about the economic calendar, Monday, Tuesday, relatively sedate, Wednesday, Thursday up here. Friday, we've not been able to get back up here. Okay, so we've taken liquidity, six. We've taken liquidity up here, which the market moves on liquidity. It's seeking liquidity. Okay, so based on that, if I go back to this 60-minute chart, when I seen this morning, I actually had this marked up, okay, and I put an alert. You can put an alert here, so click that, add alert, okay, and when the price returns to there, it'll buzz. So I actually put that, but I had it set just too high. So what I was looking, saying, right, this was through the night, we had this big reaction. So straight away, my eye was drawn to this fair value gap, okay? So I'm looking at this and I'm saying, okay, if we are bearish for today, then that should act as resistance. Right. So here, and this is, I'm just wanting to show you what's happened here. So this candle's high, the wick, if you look up at the top left, you'll see there the high is 1.15600. You see that just up in this part here? Okay, look at this part. So 1.15600. That's the very high of that wick. Now, here's the run up, okay? This runs up on this hourly candle, runs up, and what's the high on there? 15603. So 3 pipettes. Now, this is what ICT refers to as an institutional order flow entry drill. Okay, so what happens here, and I've missed it, I'm going to go in and show you. So what would happen here is I see this happening, okay, this hour. Then I'm saying, okay, it's rejected that. It's going for these lows next. Okay. This also ties in with the idea that I've shared with you, the concept of internal liquidity. So this here is internal liquidity because it's inside this range. Okay. So from here to here is your dealing range that we're talking about. Okay, so this little run up into here is seeking internal liquidity, and now the algorithm will seek external liquidity to the bottom of here. So if I go into these charts, I would have seen this happening, but I was busy doing charts. And this is the thing, guys. There's so much opportunity. I see this stuff all the time, and before I used to go, oh, and then I'd get angry, and then I'd go into revenge trading, and there's just so much opportunity here, okay? The good thing is that we're able to see these things. So that's ran up, the hourly candle's closed. I'm going, okay, now in my mind, we're seeking external liquidity. So if I go into a 15-minute chart, you see here, so this here was the close of that hourly chart, the hourly candle. This, look, same thing again. Price is fractal. So that fair value gap is now acting as resistance. Okay, there's also this fair value gap now. There to there. Okay, acting as resistance. It's permissible for this to get ignored, basically, for this to come up into here and then go lower. Okay, but you see how I'm stacking these. So because this came up here and rejected, that now draws my attention to down here. Okay, this should act as resistance. This should potentially act as resistance, and potentially here, a probably low risk sell would be enter there bring your stop loss above that high, and run it down to this lows. So you're getting a 1-to-1 ratio there, okay? So if you risk $100, you could make $100. That's probably a low risk sell, okay? There's the potential, you've always got to watch though, because there's a potential that it seeks this liquidity under this old low, okay? So we come lower, we run back up, and then we come lower. Each time it takes some liquidity, the market could then rally and bounce. Okay, so this here to me, it's a 15-minute candle, but for me, I would want to see that close, okay, below here. Then I might be looking to play this trade that I've got marked up. So it's a 17 pip stop loss, and you're going down to these lows. Okay, that's the trade. So you just drag that to the very lows, and it's a 1.12. If you entered here now, it would be an even better risk to reward. So down here, covering that high, you're into about a 1.5. Okay, so just an idea of how we use the same concepts on all time frames. Okay, I don't need this to fully reject here. Okay, but I would like to see this continue to reject. And you could potentially have your stop loss just above that old high. Okay, just to really try and make sure that's permissible for this to be running higher and it to avoid that. I was just having a look on the thing there. So with this layering system, understanding the fair value gaps, understanding that these should act as resistance, okay? And the very fact that this just tapped into there and no more, it's an institutional order flow entry drill. So that leads me to think that we're going to go from this point to this point. Okay, sure, we can come a bit higher in here, but if on a 50-minute time frame we started to come up here and close above this level, okay, then I'd be thinking, yeah, I'm wrong. And you would need to see something quite significant happen for you to then still believe. So potentially it comes up here, has another run up into here, and then you start to see displacement fast. Then yes, there's the potential that it's came in higher into your fair value gap, and then it's going to run lower. But again, this is just something that will come with experience. You're really looking to layer these concepts across all the levels, all the different time frames. Okay. And I mean, a lot of the time you should just be going for this low hanging fruit. Okay. See these simple ones. Don't try to get smart. Don't try to get fancy. There's a methodology here. Okay. This is it's systematic, if you like. You're seeing the things that you'd like to see. It's starting to reject, and this is the exact point I've made, where potentially, okay, I might have said, oh, so you could be in this trade here now, okay, but potentially I might have said, right, I'm going to set a limit order at this level, and I'm going to cover the top of the fair value gap, okay. So there, I'm getting to the lows, I'm getting 1.7, 1.8 risk to reward. Here, I've managed to still get 1.4. Okay, so potentially here, what you end up getting is you enter this trade here, you've got a bit more information. Okay, you're starting to see things that you like, especially if this 5 minutes that are left of this 15-minute candle, if that starts to close below that fair value gap, you're probably quite happy. Okay, but the potential here is that you try to jump in here, you set that, you were going to get 1.78, but you don't know. You've not got a lot of information at this point. This could have just came here, rallied through there, used it as resistance when it got above, and then moved in towards these old highs. Okay, so you're running a risk here. You've not got as much information. Here, once this comes up to here and you see this institutional order flow entry drill, okay, and it moves away, it displaces, and then that gets respected, then that fills me up with more confidence that I'm on the right side of price action. Okay, so a lot of the times, waiting for more information is when you can act. Okay, and again, this could end up coming up because that's just a small fair value gap. Okay, it could end up running up to here, and then it starts to reject from here again. Then it starts to displace. You can have your high covered just here, and you can have a smaller stop loss with maybe 1 to 2, 1 to 2.5 risk to reward. Okay, so it doesn't always, people get eager to jump into the trade. Okay, but sometimes you just need to wait for more information. And this is a classic example. Okay, because here, like I say, this could have just come up, started moving up and higher, and you've got your stop loss here, and you're going, oh no. And what I've done in the past is I move my stop loss, I double it. So I'm risking 1% there, and I think, right, I'll give it some breathing room. I'll move, and I'm risking 2% now. I'll move my stop loss on MetaTrader, and it just keeps coming and coming and coming. It hits here, knocks you out your stop loss, takes that high, and reverses. Okay, but you just need to stick to your guns. You need to make sure you've got a system. Well, hopefully you adopt this system, and hopefully I can show to you that these markets are algorithmic. Okay, so you'll see this all the time. Fair value gaps, them getting rejected. What you don't want to see here is this start to come up and through there. Okay, or you could see it, no problem, and then you use it as support. Okay, so if we, and this is the important part that ICT emphasizes, there's only two programs for the, well, there's three. You've got a consolidation, you've got a buy program, and you've got a sell program. Okay, so from here, it looks like on this time frame, we are in a sell program. Okay, so if we are to remain in a sell program, then these levels shouldn't become invalidated. Okay, and whilst it's in a buy or sell program, what is it seeking? Liquidity. Okay, so to me, internal range liquidity, it's looking for external, which is also liquidity. Okay, so I think that we are going to respect these areas, and we'll end up making our way down to here. Okay, you might get a similar sort of thing here. So look, you had 2 50-minute candles into that fair value gap, and then it dropped. So you might end up getting the same here. This 50-minute candle that's a minute away from closing, this has been respected, and then you might get the next drop, and then you might get a boom, because there's also this old liquidity here. Okay, so this could end up attacking both of these with a sharp move down and through. Also, what you can see, and as you spend time in the charts, you'll see this. Okay, it'll come down, the next move might be down here, and then it'll flirt with this low, and it'll rally back up really fast. Okay, people jump into those trades. Right, resistance, I'm going long. They go long, and bang, it comes through. It's just similar thing, a big long candle. There you go. That's you knocked out the trade. Okay, so I wouldn't be surprised to see that happen here, where this moves down fast, it stops, it generates more liquidity. Okay, and then it rallies back up. People think, yeah, that's it, it's way to go higher, and then the market just decimates them. Okay, so something to consider. And this is where each time frame is significant. Okay, you need to understand, and I say this, you need to, before you jump into a 15-minute chart, you need to understand what's happening on the daily chart. Okay, we need to understand where we are, what's happened that week, where we've been, to know where we're going. Okay, that way you can build the best picture, you can frame your trades better, and you can give yourself the best chance at success. So here's the next 15-minute candle, just opening up now. So again, when you think about the fractal nature, so potentially 15-minute chart, if we try and break it up into a wick, a body, and a tail, or a wick, tail, and a body, then potentially at the start of this, we want to see it in the first couple of minutes push up, and then for the next 12 minutes or whatever, you want to see it move lower, okay, and then maybe a whip, maybe leave a tail and come back into the range a bit, come down. That's how we want to see these things playing out, okay. And equally, so if it's on a higher time frame and I'm in a trade, and I start to see, I'm looking for the price to move higher, okay, but at the start of a new 1 hour or 4 hour candle, we start by going higher. I'm then thinking to myself, right, hold on, wait a minute. Is this a way to move higher to start with and then come lower? Okay. So once you've got this way of thinking, you can actually sit there and watch the candles for them, and you can start to put a bit of context into what is happening. Okay. What's really bullish, what's really bearish here is the fact that this 15-minute candle, it came up here, and the body, it rejected away there and closed. Okay, so to me, if anything, what I would like to see is it maybe come up, touch the bottom of that fair value gap, and then reject. Okay, but that when it's come up into there, prices travelled into there, it didn't close. Let me just, doesn't matter, I'll delete that. It didn't close, and then it comes lower for the close. That looks strong to me. Another thing that ICT mentions is when it gets to big long wicks, you can take that and move it to there. So this is showing you, this is showing you 0.5, halfway of that wick. Okay, so as the algorithm, it can sometimes run up into these halfway points and then turn and reject. Okay, so again, I think it's really interesting to watch this candle to see how it performs, and to see if we do get this run up. So again, if you think about it, I said at the start of the candle, you'd want to see a run up. So to me, this is perfectly fine. We've now reached up. There's the bottom of the fair value gap. So now you would want to see that reject from there. Okay, so we'll sit and watch this, and we'll be able to see. We'll sit and see if this actually does turn. Right now, you would want to see the 15-minute candle turn and come lower over the next sort of 5 minutes. But as we says, that is permissible, okay, for that to be running up into there. People sometimes get scared, but you've got to understand the formation of a candle, okay, and you've got to allow for these things in your trading. As soon as you're able to allow for this, then you don't get scared. Okay, you understand it's part of the process, it's part of the formation of the candle. And as I said, I mean, this could potentially get ignored and it travel up into here to touch the bottom of this fair value gap. If you were in a trade and it started to then close really strongly up into here, then you might be concerned. But look how that's rejected now. Okay. Let's see what's happening on the 5-minute chart. So you'll see how these are layered. So a 5-minute chart looks very different to the 15. Okay, because that's not a well, this is a bigger fair value gap if you like. So I like to operate between the 15-minute chart and the hourly chart. Okay, I don't need to be in the weeds of a 5-minute chart and a 1-minute chart. There is times I'll look at them, but I don't really use them for framing my trades. My trades are normally framed off the hourly and the daily, the hourly, and the 15-minute. Okay. So there you see that starting to reject. Okay, I would like to see it now come below this low, under here. And start to expand lower. Now, if this plays out like that, how can you tell me that this is buying and selling pressure? How would I have expected this to happen? And this is, listen, I'm not a genius, okay? This is what ICT teaches people, okay? He's like, how can that randomly happen? It can't. It doesn't, okay? There's an algorithm and there's got to be some form of logic to this, okay? So really, like I say, you want to see that start to expand lower. And interestingly, there's another concept that I'll just touch on here. So if, see this large down close candle, okay, that's ran liquidity here. So this was the low, it's ran liquidity and it's pushed higher, okay? When price returns to the top of this, that's an order block, okay? It's a bullish order block. So ICT also teaches, okay, so from the top of the order block to there, if we are bullish, okay, 50% of that, which is here, you should see price come down here, gain support, and not close below there, okay? It should then start to push higher. So this is why short-term liquidity objectives could be quite important, because I've been there myself where you then think, oh, I'm going to run it all the way down to here. It doesn't always work like that. But what is important, that you've got some form of understanding, okay? By the end of this, and if you come into the Discord, we'll talk through these things, okay? We won't just enter a trade and sit there hoping, okay? We'll have clear invalidation levels for our idea, okay? If we start to see things go against us, so if I was in this trade and I start to see this hit here, maybe almost like a consolidation struggling, you might start to think, oh, wait a minute here, and I'll have some other levels that I'm going, right, okay, if we start to come above there, I'm probably just going to close out my trade because I'm not seeing the things that I want to see, okay? So this has run down again. I think the low here was 5259. The low here was 5260. Is that right? 52 low, 5259, yeah, and 5260. So this came just lower. Okay, this candle came one pipette lower than here. No, I'm incorrect. It was, this one is lower, one pipette lower, right? So that liquidity there hasn't even been taken between these two candles, but it's left what you might say is equal lows. Okay, so when people see this, they'll be going, right, resistance, let's jump into a long here, okay? But when you consider the higher time frame, the order flow here is bearish. You're getting this consolidation, but you've seen something like this here, okay? So I'm under no impression right now that this is going to move higher, okay? This is just, again, building liquidity, okay? Once you see these things happen all the time, it's just normal, right? So from here to here is liquidity built along there, that area there. So we'll see that was that 15-minute candles, sorry, 5-minute candle. If I go back to here, we're still in our 15-minute candle. As I says, you wouldn't want to see price closing back above here right now, but you are allowing price to run up and come down. Okay. The close of the candles will tell you everything you need to know, really. Okay. So not so much on the 1 minute, 5 minute. It's a bit more. There's a bit more noise in there, but certainly for a 15-minute chart and an hourly chart, a lot of the times the body close of the candle tells you the story. And ICT states that the wicks do the damage, the bodies tell the story. Okay, so understanding the formation of your candle is very important. Okay, so I'm not going to sit and watch this now. I hoped that it was going to get a better reaction, and we might have took that out quicker. But we're not just going to sit here and watch that happening. Okay, but this is the basis of my trading. This is how I look at the market. I've got some logic going on in my mind, and a lot of the times it's just being able to look at the market and go, do you know what? That's not really tying in with my idea. So either I'm going to reduce my risk in my trade, or I'm going to close my trade. You might be in a small bit of profit, and you might think, you know what, this isn't worth it now because I'm not seeing the things that I would like to see. And that's fine. Okay, but a lot of people struggle to do that. But we'll go through this. We'll talk about it. We'll have invalidation levels. We'll understand where we are and what it is we're really hoping to see. Okay. Good. So yeah, that was just the idea that I was wanting to share with you that I've seen in real time. Okay, we'll go through more of these. I'll have more examples to share with you, and we'll go through them. Okay, back into the chart afterwards. So as I mentioned, we had this old low here, some liquidity sitting below here, and you see what's happened. So we came down, we fooled around for a little bit. Interestingly, and something to observe is this candle here. So I left it about here. Okay, this candle opened and it was completely bearish. You'll notice there is no wick at the top of the candle there. You see this quite often in price action. The next candle will come above there for whatever reason. Okay, so this candle opened, it rallied up above there, it came back down, it closed. We then started to move lower. As I mentioned to you, it comes down. Look how it just stops right there below the low, or just in line with the low. It then rallies back up. And then if I go to a 5-minute chart, look at the speed that we come down and we knock out the two areas that I'd mentioned. Okay, so this happens. You'll see this, and it's nice that when I talked about it in this video, it actually happened. Now, anything could happen from here. Now, interestingly, if I go to the daily, okay, so we've got this on euro dollar. So if I come into my DXY, okay, here. So this that we've not talked about yet, but we will, okay, is a volume imbalance. There's a volume imbalance there. So the market closed there. When it opened, it jumped down. Okay, this is called a volume imbalance. Now, these are really important when it comes to price action, because what you want to see, so here was one over here, okay, and what you want to see when there's a volume imbalance is if we get above here, I would then be saying, okay, we're now bullish. Okay, so depending on how the day closes, if we're above here, next week, I'll be thinking, right, we're bullish on DXY. You'll see we've taken out some big liquidity here. We took that out yesterday. Some old liquidity, that was April to May, so it's April's low we've taken out here. Okay, so it's plausible that we now turn around and we start to turn bullish for a bit on DXY. So, as I was about to say, here is a past example. So it came down, left a volume imbalance there from the Thursday to the Monday. Okay, so what happened is we came up, we pushed through it, it comes down. Okay, here we close below, so you'd be questioning, thinking, right, okay, are we bearish? But straight away we start to move higher again. Okay, so here's a fair value gap. Okay, and here, and look how the bodies of the candles here respect that. So here, when the price comes down to here, I'm watching this, okay? Here, that's completely permissible, okay? It comes down, it wicks down there, and when this candle closes back inside this fair value gap, to me, I'm bullish, okay? And as I mentioned before, I'd be taking the 0.5 from there to here, to the bottom of that tail there. That's perfectly normal and algorithmic, okay, for that to come and touch 50% of this tail. So that there, I would then be looking for higher prices, because we've got above the volume imbalance, and then when prices came down, it's touched the volume imbalance, rejected it, and it's finished up back inside this fair value gap. Okay, this is how I do my trading, people. It works. There's a logic to it, there's an understanding to it, okay? ICT knows what he's talking about. Okay, so I'm now watching this area, but I thought I would come back and just show you the results of what we were talking about when I finished up that video, okay? So now it's just coming even lower, faster. There's liquidity. There's a liquidity gap in here, so if I go to a 60-minute chart, there you go, you've got this fair value gap in here. There's news tonight, 3 p.m. UK time, 6 p.m. my time. Okay. But yeah, so it kind of played out the way we saw. This was, again, institutional order flow entry drill. And that's what led me to believe we were going to come lower. Okay.